Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. We are back with Greg Mannarino, the Robin Hood of Wall Street, traderschoice.net. Greg, thank you for coming back on the show.
Thanks for having me. I appreciate it.
Yes, thank you for coming back. I got to say, the last banking crisis that happened in March of this year, you called it. I was following you, and about 3 or 4 weeks before that happened, you were pounding the table, and you were basically saying that something is up in the banking system. It doesn't look right. And less than a month later, we had Signature. We had First Republic, we had Credit Suisse all fail, and I feel in the last month or so you've been pounding the table again like you were back then. You see something is off in the ethos of the banking system. What is it that you're seeing now that is causing concern?
I I almost don't know where to start with this. There's so many things right now that are going wrong for the entire financial sector. I've been telling people it's never been as sick as it is now. And this sickness that has made its way into the financial system and the banks. This is rearing its ugly head, but we haven't even seen the big bang yet. The big bang is going to be this commercial real estate issue, which no one is even talking about. I mean, these banks are loaded up with toxic instruments here. They loaded up on treasuries. So and now with this rising rate environment, they're seeing their portfolio value evaporate. Are also seeing loans across the board being defaulted on. So I mean, look, the reason why I was able to put this together going back before all those regional banks went down, it was so simple to deduce. In my view, we knew a couple of things were happening. No deposits, no loans, and no deals. So that was how I said, this is interesting. And the mainstream media was reporting some of this stuff. So if that was the truth, and of course it is, what would be the fallout? Well, we witnessed that. And the thing is, people are not being allowed to know that these same trio of things are affecting the major banks as well, maybe even to a much larger degree. I mean, there's something else going on that I think is not getting any attention. It's actually, that's not true. Yesterday or the day before, it was being reported, I forgot who it was, talking about withdrawals from these institutions is skyrocketing. People are pulling their cash out. I've been telling people this for I don't know how freaking long. And a lot of this is, again, the consumer can't make ends meet. The savings rate is near historic lows right now. You got a new home sales now at a historic low. So you can see how this is affecting the banks. They're in a lot of trouble right now, which really means that we are in a lot of trouble, unfortunately, moving forward. And then, what I think, again, this is going to be the next shoe to drop, and it's going to be huge, is the exposure that the commercial banks especially have with regard to commercial real estate. But you see, they're going to spin it. And the spin is pretty obvious to me. What they're going to do is they're going to blame it all on COVID. They're going to say, well, we need to, there was no way to foresee this happening. So these institutions, they're going to, in some manner or way, be made whole. And of course, again, we're going to pay for it as we always do. But I think, look, I've been telling people for a while now, to not be in these institutions if they can help it. Unfortunately, they rig the system, so we have to participate in this system that they've set up for us. But don't keep any cash in these institutions that you don't need to have in there. And find another place to put it. I mean, I say, if people need to keep their cash in an institution, look into credit unions. They're not foolproof. They're not 100% safe, but they also don't take on the risk that commercial banks do. That's a fact. They're safer. They're not 100% safe. Whenever any asset leaves your hands, in this case, we're talking about cash, there's a counterparty risk involved. So look, find places to put your cash. There are many places people can at least try to protect their cash or their wealth, however they want to look at it. Cash isn't actually wealth. These are units of debt. I think we're pretty much aware of that. We owe these things back to the central banks plus interest they create out of thin air. We work for the right to borrow those dollars from central banks. It's a crazy situation. But again, the banks are in a lot of trouble, more so than I think people understand. They're not being told the truth. Little bits and pieces sneak through via the propaganda ministry, but people need to start paying attention because this thing can potentially unfold to a much worse degree than it did during the last financial crisis.
Yeah, what you're talking about. Okay, so with the last banks, they basically borrowed short and lent long, right? Okay, so they loaded up on these bonds when they were only paying 1%, and then once the rate went up, the value of them went down, and people found that out, and they started withdrawing their money, right? Now you talked about basically their lending standards are getting tighter and tighter. I've got a friend who's in the real estate market, and he said the lending standards are just getting crazy. And this is exactly what he saw back in 2007, 2008, when people were trying to buy homes and the lending standards got tightened up to where people just simply didn't qualify. You're starting to see the same thing now, right? And you mentioned the commercial real estate. What are the banks just extremely leveraged on this, or what do you see there?
Oh, well, absolutely. Let's just back up to a moment what you just said. Your friend's 100% right. So what's going on here is pretty obvious. And I've been saying this since day one. The Federal Reserve raising rates has nothing to do with stopping inflation whatsoever. They're cutting off the availability of credit is what it's really all about. They understand that, look, they can fudge these numbers, they can float things out, whatever they want to, but we're not stupid. All of us shop, we live in the real world. We know what's going on here. This whole nonsense has just been a scam to cut off credit, mostly to small businesses who need that, the ability to borrow to function. Okay. The liquidity is drying up. They're pulling liquidity out of the system by design as well. At the same time, they're finding other ways to pull it into the system, wars, expanding wars, whatever they got to do here. But with the commercial real estate, oh yeah, absolutely. Look, this is something that these institutions have loaded up on, and who knows? No, it's a black hole. It's another one of these financial black holes. No one knows how big it is, and we're not going to know how big it is until it starts to break down. Now, the fact of the matter is, it's already starting to break down. But when this thing really comes to light, I can't imagine another way around it, but they're going to have to pump the system with trillions of dollars, trillions. That's a fact, to keep it from imploding. But again, look, what is this all leading up to? An eventual implosion. They're going to choose a time when it does implode. They're pumping the debt market to the point of no return. It's amazing what has happened. And I think this slipped right under the radar of most people. We went from the most vicious bear market in the debt market that we've ever seen in history over the last 3 years. All of a sudden, this whole thing has miraculously turned around. You got debt being bought, you got rates dropping, and this has fostered, obviously, a fire underneath the stock market, which seems to be defying gravity. And of course, you got the hope that central banks, none more so than the Fed here, are going to start cutting rates moving into 24, and I'm in that camp. I believe they're going to do that. They already got the consumer by the throat. They got the economy exactly where they want it, and they're making sure it gets a lot worse than it is right now. They're dismantling the current system. So the economy is going to continue to falter faster, and the market's going to go up. The gap between the market and the economy. I've been showing people this for like 10 years. That's just how it's going to go. You're going to see the economy and you're going to see the market go up until it doesn't. So, I mean, look, and how can we gauge the until it doesn't? It's very, very simple. There's no guesswork involved. What we need to look at is risk. We need to look at where bond yields are going. Suppressed. What people don't understand is the flow of cash through the markets. And that's the key to this entire thing. By central banks, in this case, the Fed, artificially suppressing rates, weakening the dollar, which all central banks manipulate their currencies. I can tell you how that works in about a minute if you want to. This mechanism here pushes cash into the stock market, and it maintains an illusion. The illusion of the market is extremely powerful. I've been telling people this, but I don't know how long. People think that if the market is high, If stocks are going up, the economy is strong. Nothing could be farther from the truth. I mean, yesterday they floated out this GDP number, which all of us knew was going to be vastly inflated because of government spending on the wars that are going on, but they don't tell anyone that. But meanwhile, right out of the Federal Reserve's own mouth, out of the beige book, they tell us that the economy is slowing down. So, it didn't seem like the mainstream media got the memo because they're pushing the agenda, as they always do. Economy is strong. We're doing great. Everything, everyone's happy, and we're all millionaires. You can't make it up. It's impossible to do, but that's what's going on. It's an environment of lies, distractions, and distortions of the truth on a truly monumental scale. But understanding these things, it's just not all doom and gloom. It's understanding where the opportunities are, and they're everywhere in this kind of an environment. If we understand that the Fed is going to suppress rates from here until probably the end of the presidential selection cycle, the market's going to go up. Right now, we're at this year end. Generally, there's a year-end rally. Why? Why does that generally occur? Because everyone's happy because it's, this season of the year? No, because what people don't understand is the corporate insiders, the bigwigs, the CEOs, their year-end bonuses are based solely on year-end stock price. So the Federal Reserve gets in here, props up the market, makes sure that these, those corporate CEOs and get their multi-million dollar bonuses, they distort the market. It's a game. None of this is real. It's all just an illusion.
Yeah, you mentioned risk, and I'm gonna bring up your Mannarino market risk indicator. And this thing's pretty brilliant, by the way. So basically, if it's above 300, this is extreme. We're tapping on the door right now of this. How did you come up with this? And what are we looking at here?
All right. Well, I was trying to figure out for myself a way that I could gauge risk in the market in real time. This is not a lagging indicator. This is not a forward-looking indicator. What you're looking at here is a real-time indicator based on the 10-year yield, which is the benchmark, the relative strength of the dollar, and then it's divided by 1.61, which is known as the golden ratio. It just happened to work in this situation here, so I could get these color-coded ranges, as you can see. I put a lot of thought into it. I did a lot of back testing on it. It seems to nail it to the wall. We were over 300 recently. When this thing started, the MMRI, this number here was in the green. We tapped out. Yeah, look at that. And then since that time, we've watched it drop precipitously as bond yields have been dropping, as the Fed has been weakening the dollar. All things that I said would likely happen, because look, I keep telling people they're not done. They're not done. They're not done. And I don't think they're done yet at all, pumping the market, making easy money pour into it, especially because of the current situation with seasonality, with regard to the presidential selection cycle, the illusion of the markets. They must keep this real. And people, look, they're funny. When people see their investments going up, they feel great and they get all warm and fuzzy inside. And then all of a sudden, when it disappears, which it will, again, if history has told us anything, they wonder what happened. And that same kind of a situation is going to happen, unfortunately, again. But the market, you have to understand, who owns most of this market is the 1% and 2%ers. And they're the ones that benefit from all this as wealth is sucked from everybody else. Unfortunately, it's the way the game is played. But this is a kind of an ingenious little thing, and I published this, and it's free for anyone that wants to use this right on my website. I'm just showing you right now because I think it's an excellent tool. It's not the end all, but it is a good tool for people who are in this market to gauge risk. Right now, as you can see, we are clearly at a high risk zone, but it's not really the numbers that people need to be focusing on here. The numbers are important, but even in a green zone, if you were in a low risk, doesn't mean that there's no risk. Higher risk generally can also mean higher reward too. You can look at this from many perspectives. If you're an investor, or if you're a trader in this market. I mean, as an example of that, let's say right now, the spot that we are in right now or above would present very good trading opportunities for, let's say, an intraday trader or a day trader or even a swing trader. This higher risk means more volatility generally, and that can be something that is capitalized on traders in this kind of an environment. It's a neat little tool.
Yeah, very, very cool. I'm going to share my screen here, and charts for our audience are like catnip. Here's the DXY, one that I want to focus on. And I mean, your timing here on the show couldn't be better. This is the gold chart. And I labeled these three right here. We got Convid. This is
Good for
the
you, bro.
Convid run up, right? The white line is essentially the all-time highs. So we got the Convid run up. Then we got the war premium when Russia invaded Ukraine. And then back here, you called the bank failures. And we're tapping on the door here of all-time highs. And what I love about this right now is if we close above, unless my math is off, I believe the number is 2040. If we close this month, above 2040, that will be a new all-time monthly high close. And if we close tomorrow above that, that'll be an all-time weekly close. What are you interpreting from this run up recently in the last couple of weeks in gold?
It's interesting to look at this, and I love the way you put this here. Look, I think, and I before we had a precipitous drop, as you know, recently, and so on there with regard to gold and crude oil and this contango thing, which I covered. If you want me to explain that, I will. But with regard to commodities right now, look. People need to hold commodities. I'm a big commodity guy. Everyone knows that about me. I think people definitely need exposure to commodities for the longer run. It just seems like a no-brainer trying to understand how cash again moves through the markets. It's risk on right now. So understanding that the market is risk on, we should expect volatility in commodities to occur. And being that we're touching here at the, I wouldn't be surprised to see pull back, a drop here, something. But if you look at the overall picture going back to June, it's an interesting here. I believe looking at this here, it might be a little difficult for it might be a little hard for gold to break out in this situation, especially because again, suppressed rates are driving cash into equities right now, or the stock market. But I mean, this is eventually this is going to be multiples higher than where we are currently trading. I don't even I did an interview this week to them. People were talking about the price of gold and silver and where I think it's going to go. I don't even think about it. In fact, I think the least about that than anything else, because I'm holding this stuff, eventually understanding that we are going to see a meltdown in the debt market that's going to twist people's heads around like The Exorcist, which will put pressure on stock markets around the world, which will drive cash into commodities. And I also believe cryptocurrencies in a massive way. So it's just a movement of cash through the markets. I can't figure out a different way that it's going to play out. But this is very interesting chart. I'm happy you showed this.
Yeah, another one that you brought up recently in one of your interviews was the Dow Jones Industrial Average versus gold. And so I'll back out here so we can get some real history. And this is going back to the late 1800s. And so basically this is how many ounces of gold will buy a share in the Dow Jones Industrial Average. And we can see when it started out here back in the late 1800s, it was about 1-to-1. So 1 ounce of gold would have bought you a share of the Dow Jones Industrial Average. And then we zoom in here to the crash of 1929, and it got up to 18 ounces of gold for 1 share, and then it went all the way down to 2, and then we had another run up in the 60s. It got all the way up to 27, 28, crashed all the way down to like 1. We had an enormous the dot-com bubble. This thing got up to 45 to 1, and then in 2011 it got down to 5 or 6, and we're floating around here around 17 and a half. You're a ratio guy like me, and you could see this thing correcting back to the downside, correct?
Oh, absolutely. I think honestly, and I don't know who else was talking about this, but I've been saying for 10 years that we're going to see a 1-to-1 with the Dow, trying to figure out where the Dow is going to go. The Dow, where's the bottom? No one knows where the bottom is. We do know the Fed jumped in here during the financial crisis, right, at a Dow 6,000. Could it be lower? But I think 1-to-1 with the Dow gold, I think, is absolutely going to occur. So there's some pretty substantial gains right there. Then you got to look at the gold silver ratio, which I believe if we get a 1-to-1 Dow, let's say Dow 6,000 is the bottom, and we get a 1-to-1, there you go. Now you're looking at a 15 or maybe even a 10-to-1 with gold silver. So I mean, when people, I've been asked this question so many times, and I'm just going to keep answering it the same way. We eventually are going to see an implosion like that. People aren't going to. It's just going to be beyond anyone's wildest dream in the debt market. It's going to blow up. It's the hyper bubble of hyper bubbles, and everything is now deriving value from that. What people don't understand when they look at the market, and because again, you got the CNBCs, you got the Fox businesses, you got the Bloombergs. Every day they're telling people, look at the Dow, look at the Dow, look at the Dow. What about the Dow? We're looking at 30 companies. That's all this is. They don't want you focusing on the S&P 500 for whatever reason. The Dow is the most interesting one here. But what people need to look at is the driver. What's driving the market? Okay, the Dow Jones Industrial Average doesn't derive value among itself. It gets value from what's occurring in the debt market. If we understand that this mechanism here of keeping rates artificially suppressed since the last meltdown here has caused price distortions across the spectrum of assets because of the issue with the debt market being the driver, the price driver. Forget about PE ratios, forward guidance, and all this nonsense. Don't matter anymore. It's all about this easy money that's been pumped into the system has created an environment that is absolutely not real. So just gauging, trying to think, okay, what does this all mean? Understanding that the market is so inflated. In a full-on meltdown situation, which will begin in the debt market. Look, when people look at the stock market and they watch the Dow Jones Industrial Average and it falls 5, 6, 7, 1,000 points, they start to freak out. But what they really should be looking at is the debt market. Is the debt market stable? Is the debt market, or is the illusion of the debt market being stable being maintained? Once we see a spiking in the 10-year yield. We were recently over 5%. We're like 4.3% right now. There was what appeared to be a developing uncontrolled sell-off in the debt market. We were getting pretty big moves on a daily basis. The market was responding in a negative way. So what happened? All of a sudden, the Fed sees this. They get in here. They're buying more debt. That's another thing. The Federal Reserve isn't magical. The Fed just can't say, we want to keep rates at XYZ. They have to get into the market. They have to buy the debt to keep rates suppressed. This is something that people don't have any clue about. But that's, again, people believe when Jerome Powell parades itself, he's a thing, I hate him. I really do. In front of a camera. And, when he says, hey, everyone, we're going to keep the federal funds rate at X. They can't just say it. It doesn't just happen by decree. They got to make it happen by getting into the market. So anyway, that affects everything. So when the real market crash that everyone's looking for, is not going to begin nor end with any major indice like the Dow Jones Industrial Average or the S&P 500 or the NASDAQ or the Russell 2000. No, it's going to begin and end in the debt market. That's another reason why I created the MMRI, because it looks at, again, the 10-year yield. It looks at the dollar as a unit of debt as well, because that's what it is. And comes up with that neat little equation. And when we were breaking over 300, every time the MMRI has broken over 300, this market has fallen or gotten very unstable. So what did the Fed do? They not that they're watching the MMRI, I doubt they even know it exists, but it's a neat way to gauge it. You can, the other benchmark for the MMRI is 250. Broke over 250, the market went crazy. They got in here, bought more debt. When we broke above 250, things were really getting hairy, and now we're going back down again pretty precipitously. Imagine my shock. But that's what they're doing. They're pumping the debt market. They're artificially suppressing rates. They're weakening the dollar on a relative strength basis, and this is all very, very stock market positive.
Okay, so you're saying that when the system starts to break, we're not going to see it first in the S&P 500. We're going to see it in the debt market.
Well, yes, for the most part. But I mean, when you watch the Dow fall 500, 600, 700 points, 1,000 points here, it gets people rattled a little bit. But the first thing I do on a day that the market sells off big, and it does happen, markets go up and markets go down. In the short run, anything can happen. Is my eyeballs initially, I go right to the 10-year yield. What is the 10-year yield doing? Is the 10-year yield wavering around? Are stocks selling off at the same time the 10-year yield is rising? or is it stable? Is it now? What is the relative strength of the dollar doing? So if the drivers are stable, you can imagine that the Dow is going to rebound. This is a nice tip for people that like trade an index. Okay, that for example want to let's say buy calls on the S&P 500 or the diamonds or whatever it might be. You know, if you see the Dow fall precipitously, I don't think anyone should catch a falling knife here. That's the truth. But if you see the debt market and the dollar stable, chances are more than likely within a short period of time, you're going to get a rebound. So there's a lot of little tricks to this, to trading, and that's one of them. Anyway, but that's what I do. Immediately, my eyes go to what is driving the market sell-off. Is it just because of a particular company or a Fed president said something or a geopolitical issue? And then look at what's going on with the drivers of the market. If they're stable, chances of the market's going to rebound.
Okay. Okay. I want to move on to oil here, and where are we here? There we are. Crude. Okay, so we had I'll move on to the hourly here just because it's the most dramatic. Just about an hour before we started recording, I texted you and I was like, hey, crude dropped like $3 or $4 a barrel all of a sudden. What happened? And it looks like OPEC is going to be limiting the amount of oil that they release. Last time you were on the show, it was back in August. And you called it. You basically said that you thought oil was going to come back down and correct, and it did. And what do you see as far as crude going forward right now, where we are?
I think it's going higher and much higher. I mean, short run, anything can happen here. But again, understanding the dynamics of where cash is going to most likely go at one particular. If we forget about supply and demand, people believe that the market is based on supply and demand, and it's kind of laughable. It isn't really on supply and demand anymore that's driving anything. It's easy money, it's speculation, it's whatever it might be. But traders are betting right now that the market, the crude oil is going to be a lot higher in the future, and that is what caused that whole contango issue recently. Contango being where the futures price is much higher than the spot price, and it sets this whole thing off. And you see a drop in the spot price, or the price that you can get it now. So with that said, I think we're still in a bottoming. It does look like we're bottoming here. I think we're bottoming, and anything could happen short run here. It looks like it could fall further, but I mean, there may be, even if you look at this here, it may be a setup for a little bit further of a drop. I'm not saying this is written in stone, but I think down the line here, this is going much higher. I think people do need exposure to a broad base of commodities, of course, including crude oil. As a matter of fact, just this morning, I put out a list in my free newsletter of exchange traded funds, which will give people exposure to commodities. I think people need this, and in this kind of an environment, understanding most likely where cash is going to move in the future, you need exposure here. You really, no one should be all in on anything. Okay, I know people, like, for some reason they know. In my view, you got to be kind of spread out, and be in a lot of different kind of assets here. But yeah, absolutely. I mean, for the longer run, crude oil. Firstly, you have to understand what crude oil is. And talking about the banks here, the investment banks, they're leveraged beyond their eyeballs with regard to crude oil. They've always been, and they're going to make sure that price stays up, whether they got to foster a false flag event, where they have to expand more war, or whatever they got to do. And crude oil is a big driver of this market too. Investment banks, investments in them. You got how higher crude prices pushes the entire energy sector higher, and subsequently the entire market goes higher too. If they manage to get crude oil higher, and they will, this market's, we could clearly see new record highs for this market in short order, and we probably are. And like I said, if crude plays in, it'll just happen faster.
Yeah. Okay. Okay. Yeah, we've been kind of slowly scaling into Exxon. Why do you think that? Let me go back to the hourly here. Why is it that if they're limiting the supply that's going to come out, that in my mind would drive prices up. Why would prices drop so significantly in such short order when they announce that they're going to release less? Do you understand
It
that?
could it could be speculation that maybe they're not going to do it for a long period of time. I mean, anything could drive this market in the shorter run like that. The market is, rumors, the dreams of rumors, wild speculation that can drive the market. Some big players out here. But again, these little dips. I mean, look at the one prior to that, didn't seem to last too long.
Yeah, yeah.
And
That
if
was a
you look
tick
at
if you could catch it.
yeah, I mean, these are really difficult, and you look at the averages. It does look like it's going much higher here. I
Yeah.
wouldn't be surprised to see this rebound and then some moving forward. I believe that we're going to see within a short period of time, crude is going to be back over 80, and then much higher than that down the line. So
Okay.
yeah, that's just kind of my take on it.
Okay. I want to close out here with platinum. And platinum has been getting pretty cheap. I'll pull up the platinum chart here, and we can see that we are, if I zoom out here, let me go into the weekly, we're pretty cheap. The chart I really like, though, is the platinum to gold ratio. And so I put these lines here historically, what it can get to. So up back here in '08, and then again in '01, and we got a tick there in '04, it got up to over 2 gold coins for 1 platinum coin. And now it's the opposite. It costs you 2 platinum coins to get 1 gold coin. Do you see the same opportunity here that I do? We just bought some more platinum, and I want to get your take.
Absolutely. I own platinum. I own
Okay.
palladium too. The physical. I don't own this, but I do own the real things, and I think absolutely. I tell people basically in the hierarchy of precious metals, silver is my favorite. Second would be gold, and then platinum and palladium run an equal third. That's
Okay.
kind of how I feel about these things. Absolutely, there's opportunity here. It's kind of the platinum and palladium are kind of like the forgotten metals in many ways, but they people should own some of it. I mean, I really believe that too. But if people need to own, or they feel they can only afford one, then it would be silver in my view.
Yeah.
But this is great. This is a great opportunity to buy. I think you guys are doing the right thing.
Okay. Okay. Yeah, I think so. I think if your time frame is 5 years or so, this is going to reverse. It's not going to
Absolutely,
stay
it's
this
going
cheap
to
forever,
reverse. There's no doubt about it.
right? And the
Yes.
thing I love about this bet is platinum only comes from a few places on the planet. The 3 main ones are South Africa, Russia, and Zimbabwe, all of which are a dumpster fire politically, and anything could happen in any one of those regions that would drastically cut the supply and increase the price.
Makes sense to me, man. You're talking my kind of language here.
Right on. Awesome. Well, thank you, Greg, very much. Where can our listeners get a hold of you if they want to get more Greg Mannarino?
YouTube, anywhere, Google, website. Pick a place, you'll find me somewhere.
Okay, awesome. We will put a link down in the show notes. We'll also put a link to your MMRI index. And thank you very much for coming on the show, Greg.
Thanks for having me. I appreciate it.
Yes, sir. And thank you for tuning in. Support the show. Hit the like, subscribe, put comments down below, and share this with anyone that you think needs to hear it. You have yourself a great rest of the day, and we will talk to you next time.